after the RBA increased rates on 12 occasions. And we have our business team on hand for the decision. Peter Ryan is outside the Reserve Bank in Sydney, and Alicia Barry is in the studio with me. Alicia, to you first of all. So what, a rate rise virtually all but certain, would you say?
It does seem that way. I mean, there is a small chance that we could see the cash rate on hold at 4.1% for a fifth month in a row. But after the inflation figures came out a couple of weeks ago, they did bounce back in the quarter. They were stronger than many had expected. And that has tipped many economists over the line to think that the RBA will increase the cash rate. Michelle Bullock, in her first sort of 6 weeks or so, has been very vocal about the need to get inflation down. She's worried it might not hit the target band by the end of 2025. It's currently sitting at 5.4%. Not only economists, but markets are broadly pricing in the chance that the RBA will hike too. There's a 67% chance at the moment priced in by markets that we will see the cash rate increase, but we'll find out very shortly.
Indeed, we will in just a few minutes' time. Let's go to senior business correspondent Peter Ryan, who's down there where it's all happening outside the Reserve Bank in Sydney. So you're expecting a rate rise too, Peter?
Well, I checked money market probabilities a short time ago, looking like a 70% chance of a rate rise today. But if you talk to economists in particular, each of the big four economists at the banks, they think it's a near certainty, not because they think the Reserve Bank Board should raise rates, but simply based on inflation and Michelle Bullock's language that if inflation looks like becoming problematic, staying above the 2 to 3% target band beyond 2025, well, she really does have that ability and that requirement and that mandate to act. So if you look at Michelle Bullock's language, you look at where inflation landed in the most recent quarter, 5.4%, well above the RBA's 2 to 3% target band. It might be slowing, but it's not slowing fast enough, if I can put it that way, and that's a big concern. And the RBA board may, after a vigorous debate, feel as though it is appropriate to tap the cash rate up to 4.35%.
And Peter, the IMF came out last week to say that inflation here was too high. Was that the final nail in the rate rise coffin, if you like?
Look, I really think the final nail in the coffin was the quarterly CPI we saw a couple of weeks ago. Everyone had been hanging out for that just to see whether or not inflation was going to be ticking higher. And I think that is the main consideration. Also, the jobs market is resilient. The unemployment rate still very low at around about 3.5%. So these are the big factors. The RBA board makes decisions based on the data that's available to them, and all the data they'd be seeing at the moment is that the economy looks like it's not only resilient, but in some quarters, not all quarters, it's a bit hotter than they'd like it.
So we've already had 12 interest rate rises. Peter, why isn't inflation under control by now?
Well, you'd think that it might be, but 12 interest rate rises since May last year, remember, it's come up from near zero levels. There is a significant lag, though. Even though we have had 12, we've probably only felt the impact of about 6. And it may not be until early next year, when a lot of those fixed rate mortgages expire and move back into the higher rates world, that there really will be a thud. And that's one of the other considerations for the Reserve Bank, is they have to be careful not to actually be too preemptive and lift rates too high, not just today, but perhaps even talk of a follow-up in December. And that's the risk, the narrow path they keep referring to. And if they really miss out on that narrow path, there could be a recession. And then all those people worried about high interest rates may be seeing them fall a bit faster than they might expect.
Right, so it is 2:30 Eastern on the dot, the time when the Reserve Bank announces the rate decision. Alicia, you have it there.
Yeah, as expected, the cash rate has increased from 4.1% to 4.35%. Not welcome news for those who are paying a mortgage, no doubt. That is the 13th rate rise in 19 months. As you can see there, it has risen extremely steeply in the last 19 months since May 2022, as Peter was talking about. It It's the steepest hiking cycle since the late 1980s as the bank aggressively targets inflation, which is yet to fall close to its target band. And whilst this may be good for savers, for those with large mortgages in particular, they are bearing the largest burden. If we take a look at the average mortgage size of, say, $500,000, this latest interest rate increase adds another $76 per month to the repayments. That's over a 25-year horizon. If you take the 13 interest rate increases in total, it's another $1,210 per month. That's around a 52% increase on what that borrower would be paying before these interest rate increases were enacted. This is based on Rate City's data. And if you go down to $1 million mortgage, which is not unusual for big capital cities, you can see there it's another $152 a month, but those total 13 increases take the extra repayments in total to $2,420. And of course, as Peter says, not all of that is being felt just yet. There's still a bit more to work through the system. So there is more pain coming, unfortunately, for those with mortgages. I will bring in now Shellie Murphy, the EY Oceania chief economist. Shellie Murphy, not an unexpected decision.
No, I would have been very surprised if the Reserve Bank had held the cash rate steady at 4.1, given those very obvious inflation pressures which were creeping up again in the September quarter. That plus, as you said, Michelle Bullock's words, which suggested that the Reserve Bank board had a low tolerance for inflation to escape outside its forecasts, meant it was pretty certain that they were going to go today.
Yeah, and so when we see an interest rate increase after 4 months of pauses, does it normally mean that they're going to do another one?
Look, it can do, but every situation is quite individual. Of course, you've got the domestic forces in the economy, and generally, yes, those tend to sort of roll with each other. However, as we know, we've got a number of international forces hitting the inflation forecasts at the moment as well. So I would say that just because that's what they've done in the past doesn't necessarily mean that's what they'll do in the future, but certainly would say that the risks to inflation and the need for another rate hike are still there.
Well, I'm just reading through the statement now, and it does seem as though the RBA is at pains to reiterate that it's very data dependent, saying whether further tightening of monetary policy is required to ensure inflation returns to target in a reasonable timeframe will depend on the data and the evolving assessment of risks. They also go on to say that they're going to be resolute in its determination to return inflation to target. Do you think that's a slightly more modest statement from the RBA today?
Look, it's pretty much as I would have expected. They're certainly not willing to rule out the need to put up rates any further, and we knew that they would continue to hold on to that sort of hawkish stance so that consumers didn't get too comfortable with the idea that rates are necessarily going to be on hold here at 4.35%. It would have been a surprise for them to pull back on the language, because any pullback might have given markets and consumers, in fact, a direction that things were okay, and we're certainly not out of the woods yet.
Sure. And I mean, as we see these interest rate increases work through the economy, Peter Ryan mentioned a lag effect. It's also disproportionately affecting those with mortgages.
It certainly does. And in fact, for some households, this is, of course, an advantage. If you're lucky enough to have paid off your home and sitting on some savings, then actually, of course, this makes you better off. But for the approximately 1/3 of households that have a mortgage, it is another few dollars that they have to find every month to meet those mortgage repayments, which have gone up a lot. And of course, it's much more impactful for those who have recently bought a home or have few savings, because they're the ones that are really feeling the brunt of this.
And we talk a lot in aggregate. We talk about the unemployment rate being at a near 50-year low. The economy is going pretty well on aggregate. Is the financial hardship that we're hearing anecdotally starting to show up in these average numbers yet?
It is interesting that the household sector as a whole have been able to cope with these rate hikes as well as they have. And I think that's probably got a lot to do with the very unusual few years that preceded the Reserve Bank's rate hikes. And of course, I'm talking there about COVID and the fiscal stimulus that was injected into the economy in that period of time. A lot of that went into household savings accounts or redraw accounts, offset facilities on mortgages. And so it gave the household sector a real buffer upon which to cope with this higher interest rate environment. Now, certainly that is wearing thin, and those extra savings are slowly being used up, and we're certainly seeing less saving than we had, but it is seeming to make quite a big difference. Yesterday, when we saw Westpac's results, it was quite clear that the mortgage arrears remain really very low by historical standards. So yes, it is quite surprising, I think, how well the household sector is coping with these.
And just a quick outlook question. I know you don't forecast interest rate increases, but when we look across the globe, we saw the US Federal Reserve indicate, or at least markets took it to indicate, that it might be done with raising interest rates. Do you think we could now be at the peak?
Yes, it's certainly very possible. If the Reserve Bank, even just a few months ago, was quite satisfied with where interest rates were, it's just that some of the data didn't play exactly in line with their forecasts. Now that they've tapped basically tried to slow down the economy a little more, we'll get its updated forecast on Friday in the statement on monetary policy, and that could prove that the RBA is quite happy with where things are at now. However, as I say, the risks are to the upside. We still have a strong employment market, as you noted. Some parts of the economy are still running quite hot, even though the consumer has slowed down, and these too can create inflationary pressures. So that's the kind of thing that they're going to be watching over the next few months. But I think jury's still out on that one.
Shellie Murphy, appreciate your insights. Thank you so much.
Pleasure.
And so, Roz, every piece of data that comes out now is going to be very closely watched by markets and economists alike, including that statement on monetary policy, which Shellie Murphy mentioned, which will be out on Friday with updated forecasts from the RBA.
OK, we'll closely watch that. Let's go back to Peter Ryan now down at the Reserve. Peter, you've also been looking over that statement from the Reserve Bank. What jumps out to you?
Well, Roz, about halfway through the statement, there's a significant line where Michelle Bullock says that since August, the risk of inflation remaining higher for longer than expected has increased, and also that core inflation, which strips out those volatile items like fuel and food, is higher than the Reserve Bank Board would prefer. So, as we were saying before, it's all about inflation. Michelle Bullock has pretty much kept to her word that if inflation looked like running away or becoming entrenched in the minds of consumers or businesses, she would have effectively an obligation to act to tap the brakes once again to ensure that inflation doesn't get away. And that's the main theme from this statement. Also that they're seeing the economy much stronger in the first half of this year than expected, despite those 12 rate rises we saw until today. We've now had the 13th. So there are those concerns there, and as we always do, we go to that final paragraph, a little bit of change, commentary, but pretty much the same, resolute about doing whatever it takes to keep inflation down, probably keeping an open mind on whether or not a follow-up rate hike is required, but very clear that if inflation needs another rate hike to pull it down again, they're going to be doing it.
So there might be another rate rise in December then. When's the next quarterly inflation report due out? Is it before the December meeting?
I think it'll be after the December meeting. I don't want to be quoted on that, but I think it's after the December meeting. But we also have the monthly inflation reading, which will also be very, very important. That'll be coming up. That, of course, is not as significant as quarterly because it looks at a different basket of goods. But every bit of data, as Alicia was saying there earlier, the Reserve Bank Board's going to be data dependent, as they like to say. They'll be watching that very, very closely. So I don't think we can say that the RBA's cash rate has hit its peak yet. maybe not by a long shot. And so it's really going to be dependent on the type of data they see, whether or not another rate hike's required. But also, on the other hand, we do know that consumer spending is being hurt, and that's all important in the lead up to Christmas, where pretty much consumer spending or retail spending has been pretty much flatlining recently. So that's going to be important, as well as we determine whether or not these rate rises might spark a hard economic landing rather than the soft one.
Alicia, finally to you, have the markets reacted? Have they priced this in?
Yeah, look, there's a fairly muted reaction on the markets because it was largely priced in. If anything, we've seen the dollar come down very slightly. It was sitting at 64.8 US cents. It's now 64.6 US cents. So perhaps at the margins, investors, at least in currency markets, are reading this to think that the RBA might take its time if it's to raise interest rates again. At the same time, the market has come back a bit. It was down 0.4%. It's now down 0.2%, but it's really at the margins in terms of a reaction. They're fairly muted from the markets.
Okay, well, that's where we'll leave our rates coverage. A reminder, the Reserve Bank has raised interest rates by 0.25 percentage point to 4.35%, as predicted by most financial commentators. We'll bring you reaction to the Reserve's move during the course of the afternoon. Alicia Barry, Peter Ryan, thank you both. Let's get more now on the Prime Minister's visit.